You know, a financial crisis doesn't begin with an explosion. It begins with a crack in the foundation. So I want you to imagine for a minute a massive suspension bridge, elegant, trusted, and carrying the weight of millions every single day. From the surface, everything looks solid, but deep inside the steel, a tiny fracture forms. Most people don't see it. Most don't want to. But once that crack begins to spread, the entire structure enters a doom loop. Tension increases, cables snap, weight shifts, and suddenly the whole bridge is pulling itself apart. Well, I hate to tell you this, but that's our financial system today. And that first fracture, the one that determines whether the bridge stands or collapses, that's collateral. So I'd like to welcome you to a 5-part series on the doom loops of a financial crisis. And today, we're going to be talking about the collateral doom loop, the foundation of everything. It always begins the same way. The trigger is simple. Collateral values fall too fast, and the effect is immediate. Lenders demand more collateral. Those are margin calls. The outcome is inevitable. Forced selling, which pushes collateral values down even further. And once this loop starts, it feeds on itself until something breaks. So this is the collateral doom loop, the collateral failure where the system runs out of trusted assets. And this is significant, and I'm going to show you why. After the US dollar became pure debt in 1971, the system transformed into a classic total Ponzi structure. And every Ponzi scheme requires 2 key things: new money and confidence. So what did policymakers do? They created new pipelines of money for Wall Street because, after all, we have to feed the beast. 1974, they came up with IRAs. 1976, portfolio insurance. Remember that. We're going to talk about it again in a second. And between 1978 and 1981, they created 401ks. Frankly, these were not created to help workers. They were created to feed Wall Street, generate fees, and shift retirement risk from corporations to Main Street. This is how the system kept the illusion alive. And here's the loop visually. Collateral falls, margin calls, forced selling, liquidity evaporates, collateral falls even more. This is the engine of every single modern day crisis. And frankly, once the selling starts, the system becomes its own worst enemy. Black Monday, I was there. It was the very first algorithmic feedback crash.
As the Dow Jones Industrials took off on a fear-fed freefall to close down a record 508.32 points, panicked traders worked through lunch hours in a desperate but losing attempt to keep up with tickers that rolled up an all-time high volume.
We've got everything on algorithms now, but back then, this was the first one. And I have to tell you that it was the portfolio insurance, that new product, that new experimental product, the early version of automated selling. That's what triggered a cascade of forced liquidation. This was the moment the market shifted from investing, where we could see true supply and demand dynamics, to leverage speculation. And the era of feedback loops had begun. Now I want you to fast forward to 1998 with long-term capital management and the Asian currency crisis, because that was the next domino to fall. And actually what happened, the Asian currency crisis destabilized the global markets, and Russia forced Russia into default, which lit the fuse. Long-term capital management was supposed to be the smartest guys in the room on all of this algorithmic and leveraged trading. And they were really just a massively leveraged hedge fund. And they imploded when it's derivative bets. And a derivative, that's all it is. It's a big, fat, leverage bet. Well, that bet blew apart with what was considered the safest collateral, government bonds. This was the first major derivative-driven collateral failure. So you see how it's building on each other? And again, markets in all of those countries, they collapsed as confidence evaporated. Fast forward to 2008, because that was the securitization freeze, that level of collapse. And really, the securitization market, the lifeblood of mortgage finance, because they sell you a mortgage and then they take that mortgage, they put it in a pretty package and they sell it to somebody else. You're promised to pay that mortgage. And the lifeblood of mortgage finance dried up overnight. Can you see it in this chart? No buyers, no liquidity, no collateral. The system froze because the collateral backing trillions simply stopped trading. Because during that period of time, money markets froze and broke the buck. This was the second derivative trading collateral failure. So let's go to what happened to the normal person, to your 401k, because I had a client that was in the reserve primary fund when it broke the buck. What does that mean? That means we've been taught that money markets are like savings account. You put $1 in, you get $1 out. But that's not what happened in 2008 when the underlying assets, the collateral in those money markets declined below $1. And so what did they do? They just eliminated your ability to get your money out. That's all. Capital incarceration is really what that is, but people don't realize it. And this was supposed to be the safest cash equivalent asset in the world, but it started a domino effect that went from one asset to another to another. That's when confidence collapses instantly. And that's why they had to halt distributions and raise the limits on the FDIC insurance from $100,000 to $250,000 because that confidence evaporated. So this is the stage 3 of that doom loop. Borrowers can't meet the margin calls. And so that forces more selling. And frankly, this is the moment when margin calls go unmet and lenders then seize assets. Borrowers liquidate whatever they can. People always wonder why, well, they call it gold. It's really the spot gold contract falls when the rest of the market is falling. It's because they've got to meet margin calls and they've got to sell what the market will buy. Selling pressure cascades across markets, and that's the domino moment. Each forced sale knocks over the next asset class in the next institution, in the next market. So here we are, because that takes us right to the sovereign debt crisis, which is still an extension of what happened in 2008. Do you remember that? 2011, 2012, wasn't that long ago. But that's when Europe's sovereign debt crisis followed the same exact patterns. Bond values fell, collateral failed, and governments had to bail out banks that quite honestly were turning around and bailing out the governments in this big collateral doom loop. And for the first time, we saw the next stage, bail-ins, where depositors, not taxpayers, take the hit, though I dare say it will be a bit of both in here. That leads us to bail-ins. Because in every crisis, The financial system fractures like a stressed suspension bridge. But here's the part that most people, frankly, they never see it. The insiders are standing near the exit, and the public is standing on the weakest part of the span. In Cyprus, that's where they did that first bail-in. Those big European banks, that black line, well, those were mostly German and French banks, and they very quietly stepped off the bridge before the cable snapped. But local families, small businesses, and retirees, well, their deposits are what's called sticky. So they were still out on the deck when the bail-in hit. They absorbed the shock because they were the last ones left standing on that failing structure. If they had their wealth in their hands in gold and silver outside of the system, they would have been just fine. But that's actually not what happened. It's tested. And this is the pattern. The insiders feel the vibration first. They know about it. They know what they're doing. And they move to safety. The public feels it last when it's too late, when they see it, and they pay the price. All right, well, now let's talk about what happened in 2022, because that is a very key date, since that's when, on a global basis, central banks began to raise rates yet again. In 2022, the UK gilt, so that is the UK's government bond, that market blew up. Rates spiked, collateral values collapsed, and pension funds faced margin calls. Pension funds, right? This is supposed to be for retirement. Well, if you don't know it yet, we have a huge retirement crisis in the loop, but we can't talk about that today. We'll talk about it another time. But in this case, the Bank of England had to reverse course overnight to stop a systemic failure. We get all of these clues. The question is, are we listening to them? Or because it didn't personally impact you, you go, that's okay. I don't have to worry about it. Because it's not okay. It's danger. And what happens is that domino effect. So once we get one failure, we see a whole bunch of other failures. Now, the Bank of England narrowly contained this failure, but the IMF, the International Monetary Fund, notes that the turmoil exposed vulnerabilities across the broader sector. Insurers, pension funds, leverage funds. Can you see those vulnerabilities? Because it isn't just, that's over there, over here, that can never happen, which is what people always seem to think. But I'm telling you, it's a warning. Will you take heed? But I want to show you the signals and why I think that this is a real strong probability and possibility. Because in January, Microsoft gapped down 11%. That is a massive move for a mega cap. These are the stocks that have been pushing this market up. And the technicals confirm the trend. The 50-day moving average crossed below the 200-day moving average. And this is the kind of break that starts collateral stress, because it's telling you the most likely outcome is for the prices to continue to go down. And that was before we had that 11% drop. That move spilled into other riskier assets. Bitcoin, already in a downtrend, broke below, I'm saying 85,000. It's below 70,000. That trigger forced liquidations. That's a textbook collateral doom loop. One asset falls, margins calls hit, forced selling spreads, and traders get forced out. This is what collateral failure looks like. The system runs out of trusted assets because it's all being guided. It's a trading market. It's not real. These stock markets, these bond markets, these crypto markets, they are not real. And when the confidence in those collateral break, everything built on top of it, everything begins to unwind. Why is gold and silver so volatile? Because of bets, not because of the sound money, not because of the physical metal. Here's the data. Manufacturing business confidence is below zero. Consumer sentiment is barely above the lowest level ever recorded. We are definitely coming up to a major confidence failure, and this is what it looks like. These are the indications. What are you waiting for? And of course, silver, it's always the fuse. It reacts first when confidence breaks because it's the most sensitive monetary metal. It is the secondary monetary metal. So it's the early warning signal. So why is silver the fuse and why is it so sensitive? Because it's used in 36 different areas. The physical metal itself is used in 36 different areas of the global economy. So while it's a monetary metal, it is very sensitive to what's happening in the direct economy. But there is a finite amount of it. And with all the data centers being built out and all the technology, it is a required essential metal. So it's going to be a lot more volatile. Let's take a look at this breakout because we can see the two huge cup formations that we've talked about over and over again, which are accumulation patterns. And you can see them this is spectacular. I've never seen anything quite like it as I've shown you before. And then we had the breakout. So what in the world does this breakout mean? The fuse is lit. Now look, nothing goes straight up, nothing goes straight down. You're always going to get bouncing along the way. I'll show you this technically, but this isn't even really silver. This is the spot silver contract. Nobody ever calls it a contract, but that's exactly what it is. And they can make as much silver, and they have, as they want to. Whereas, as I just showed you, in the physical world, there is a finite amount of it. So this is really where physical meets digital, and the physical is winning. We'll talk more about that in another video. But let's go on to gold, because really gold is the anchor, and it is the ultimate and only collateral that runs zero counterparty risk. And that's not according to me. That's according to the Bank for International Settlements, the central banker's central bank. So that's only one of the reasons why gold is the anchor, but let's take a look at how much there is of it, because again, there is a finite amount of it. It does not get used up in production. It's the primary currency metal used in 33 sectors of the global economy, the physical metal itself. But there you have it. Silver is the fuse. Gold is the anchor, and take a look at the chart because it's just not as volatile. We can still see the two cup formations, but you can see how less volatile spot gold contract is. And I make a big point of that, you guys know, because again, they can create as much gold that does not nor ever will exist as they want to. But you want stable collateral? If you don't hold it, you don't own it. This is the most stable collateral you can ever have. Because while the loop begins with silver's ignition, the signal that confidence is breaking, and it ends with gold's revaluation, the reset of the system's collateral base. That's really what those overnight revaluations are. So let me show you, because history does it all the time. History shows that when confidence collapses, that's really what you see. governments revalue gold overnight, not gradually. So they take something that is used in every single sector of the global economy and they revalue it in terms of what has no intrinsic value and is only used in one place. That's that overnight revaluation. They always do it with gold because gold is the ultimate collateral running zero counterparty risk. They don't do it politely or easily. I mean, they do it over time. Hence this face value of $20, and we're spot right now, right? Over 5,000. But that's still gradual compared to those overnight revaluations. And that's what we have in our future when all confidence in the collateral is lost. They go to the only asset that is all collateral. And the Federal Reserve has documented this in their own research. Official reserve revaluations, the international experience. Every single central bank has a gold revaluation account, every single one. They know how this works. They know how it ends. And now, so do you. Because we've walked through every crisis. 1987, I mean, there are more. There are smaller ones. But 1987, 1998, 2008, 2012, 2022, and now. They all follow the same physics at that cracking bridge. Collateral weakens, confidence slips, and the system begins pulling itself apart from the inside. Each domino that we saw, it wasn't a new story. It was the same story repeating with bigger and bigger stakes and thinner margins because there's less and less value in this. And just like a falling bridge, once that load becomes too great, the structure doesn't slowly bend, it snaps, it collapses. And when that moment comes, the system reaches for the only material strong enough to rebuild the foundation. Real collateral with zero counterparty risk. Gold is the anchor. But remember, silver is the fuse. And revaluation, that's the reset. This is the loop. Silver signals the break, gold restores the balance, and the system, every single time, over 4,800 times, they're forced to reprice the only collateral that they cannot print. The cracks are visible. The tension is rising. And this next revaluation, that won't be a theory. It will be an overnight event. The question now isn't if the bridge will be rebuilt. It's whether you're standing on the collapsing side or you're standing on the anchored side when it happens. And until next we meet, please be safe out there. Bye-bye.